And welcome to another edition of the Nerdy Asian Podcast. I'm your host, Luke Pedersen, with my brothers and fellow nerds, Josh and AJ. Today, we are making a little bit of a last-second change. We were going to talk about how you can discuss the new contracts with your clients. We're going to pick that up next week, which I think then will hit perfectly for the week. You're going to have to start discussing that with them. Today, we're going to chat about the changes in the interest rates and what the market in general has been looking like. Just because that happened so fast, we wanted to get this out to you. So just to kick it off, you guys give like a high-level overview of what happened, and then we'll get into the weeds a little bit afterwards.
What I'm starting to understand why stock market crashes happen on Mondays. I think that like most of them are Mondays, right? Like the big one back in the Great Depression was a Monday. There's Black Monday. There's all these Mondays. I think it's a lot of times Mondays. And I think the reason why is what happened is we had a really low jobs report. It was like,
what does it mean to have a really low jobs report?
We were expected to add, what was Josh, 196,000 jobs, and it ended up at like 110.
Yeah, it was low.
Really low, right?
And we've been overshooting the jobs report, which has been part of the reason why we've seen mortgage interest rates stay high, because if the jobs report is good, everyone thinks the economy is good, everyone thinks the Fed's not going to cut rates, so therefore all the rates kind of stay up. This is the first time, and we've had some mixed signals about whether or not those were correct numbers, because they've been coming down every month when they've been redoing them. But this is the first time the jobs report actually looked kind of scary, I guess, to people.
And unemployment over 4.3 at 4.3, I should say, and I think it was projected either 4.1 or 4.2. One of my buddies yesterday was messaging me on Instagram. He was saying that he thinks a lot of the unemployment was due to was it like a tornado or hurricane down south that wiped out a bunch of jobs? So I don't know. That was what he was talking about. He must have read something somewhere. But anyway, so the jobs report comes out bad on Friday morning here in the United States. By the time it comes out, I believe the Japan markets are closed for Friday because they are ahead of us.
Time zone change, yeah.
So then Monday opens up. So our markets trade, yields trade down sharply here. Mortgage rates dropped pretty dramatically, and that even bled into Monday. Well, on Monday, when Japan's market wakes up, opens up, they lose 12% of their benchmark index. 12% of the value of all the companies, right? So one day, it was pretty wild.
Why did they do that?
Because they felt because the United States is always driving so much of the economic action, and if the United States is looking like it's weak, then other countries start to trade in the same direction.
Sure.
Everybody's kind of watching our economy thinking a recession is coming, We've heard that, right? It's like almost been like, like a false alarm over and over and over again. But in this case, it was kind of like, okay, it might actually be happening now that we have poor jobs data for the first time in a while.
And I think the currency, like the U.S. to the Japanese currency, is a little bit interesting and weird. And there's a weird trading thing that people are doing that was
They've been, so don't quote me on this. I believe Japan's been giving out money at incredibly low interest rates.
Oh.
Right? And then they've been using that money to invest in other markets.
And
that could be wrong, then.
There is. It's called like exchange trading. And so what people will do is they'll exchange their U.S. dollars for dollars in another country, and then they'll loan it out in that country's dollars.
Yeah.
And then they'll use that money to invest in another country to try and arbitrage.
Weird. Yeah.
But anyway,
so when that market went down really fast, though, it affected a lot of people that were doing that.
The dollars got affected a lot because the rates got screwed up.
And because that closed before our market then opened, our market was opening on Monday with the knowledge that Japan's market had dropped 12, and our futures started looking poor the night before. And in the morning of, everything exploded in the stock market.
The NASDAQ was off like 6.5% on the open.
S&P was off over 5.
Yep. And the Dow was down like 3. So Dow usually moves the least volatile. NASDAQ with all those tech companies obviously was ripping down. So it was really interesting to kind of follow. But what happened then, and the yields were trading 15 basis points off. In the morning, the 2-10 yield spread actually went back to normal, quote unquote. It's been inverted for 2 years.
What does inverted mean?
Inverted would mean that the 2 years the 2 years been trading at a higher value than the 10-year, which basically means there's less demand for short-term money, which means that there's poor outlook on the near term
economy.
When the market starts to flip the other direction and the 2 year starts to trade at a lower amount than the 10-year yield, that typically marks the beginning of the recession. So if you look at all of the last 5 recessions, the yield curve inverted. So 2 traded above the 10. And then as they started coming back to quote unquote normal and not being inverted, that's when the market was saying that's the recessionary period. We went through the recession. They started to spread out even more, 2-year getting cheaper and 10-year getting better, which means over time, the short-term outlook got better and better and better as we got further into the recession, because eventually the recession ends and then the bull market starts again. So that happened yesterday, but they didn't close that way.
Well,
they
thing
snapped back.
The thing to call out,
it uninverted and then inverted again.
Re-inverted.
the other thing to call out
Wicked.
is if you think about, we're talking about the stock market. Everyone's like, why does that matter, right? Because we're talking about stocks versus mortgage rates. What we're trying to bring value to you on is mortgage rates. The reason it matters is because when people sell stocks, which is what's happening when you're seeing stock prices depress very quickly, they're fleeing the riskier asset of a stock to a safer asset, which is typically either just holding a bunch of cash or it's putting it into bonds. And so when they're buying the bonds, the prices of the bonds are going to come down as well because there's more demand for those bonds. So the yields are going to go backwards on those. The mortgage interest rates are tied very closely to those bond prices. So in the event of economic compression, bond prices are going to go down. Excuse me, I got these late summer allergies. As people are fleeing more into them, which is going to eventually trickle back towards interest rates on the mortgage side. So we saw a compression because of the 10-year compression. There's also, because of the stock market hitting so fast, so aggressively yesterday morning, there was a fear that, or not a fear, a belief that the Fed may jump in and make an emergency rate cut because they've still been holding steady, but there's been more comments about they're thinking about rate cuts.
And when the market's doing poorly, the Fed combats that by lowering the overnight rate because they try and
when the
get
economy
people
is
to
performing
spend.
poorly.
Sure,
Yes.
when the economy's poor, they do that to try and get people
They're
to spend
trying to
money
balance the
boost
economy.
Yeah, and if they do an over, let's say they did, because one economist that I read was like, we should do an emergency 75 basis point cut.
Holy.
And if they did
Hit it with
that,
fire.
if they did that, then they would be terribly concerned that would lead to inflation picking back up again, right? Because if it cuts again, now you're seeing mortgage rates dropping well into the 5s probably, because that's an overreaction for what the market's expecting, well into the 5s. And then the demand for buying gets better. People can afford more. So real estate prices go up. People borrow more money to buy new cars.
Real
People
estate
borrow-
would rip if they did that.
Yeah,
And that
Unless,
would
unless
not
the
be-
jobs report was actually really, really real and people had less money and all these things.
Then they couldn't buy houses anyway.
Correct. Yeah. So it's they're trying to balance all of these different components. But when you think about interest rates, the expectations about some of the things that are happening and what they will lead, the things that are happening and what outcomes they'll lead to, or how are everything's trickling through to interest rates.
So then all that happened. The interest rate was what? 7 and a quarter?
It was 7.25 2 months ago, I think.
7 and a quarter 2 months ago. So then yesterday,
6.34 is
like
the
the low-
average rate on Mortgage News Daily.
what it is today.
And it was
some
lower. It was
guy-
lower than
you-
that in the morning. I had a client that was looking in the high 5s, low 6s, kind of.
And the Home Ready Home Possible loan is always going to be less than that. So if that's 6 and a quarter, Home Ready Home Possible was like 5.875 there for a little while.
Yep.
For first time home buyers that fit it with income qualifications. So the rates went down like almost a full percent.
Yeah, in a couple months. And I think what's fascinating is to what Josh talked about earlier about the jobs stuff. It truly does seem like people have less money right now, at least when we're looking at real estate, because the rates last year at this same exact time were firmly in the low to mid 7s. And we had about 2,000 less homes on the market in our metro area here in the Twin Cities than we have today. So what we're seeing right now is we're seeing more listings every single week. There's more listings hitting the market than last year on a week versus the same week comparative basis. We're seeing less pending sales every single week. We're going to have less sales in the Twin Cities this year than we had last year. That's what's going to happen by the end of the year, is what it's looking like. And we're seeing more inventory, right? So it's just a math problem. How many listings got added, how many sold, and then how many still are sitting on the market. The inventory is sitting at like 9,500 listings. And last year it was like, around 8,000, I want to say. So quite a bit more inventory and less buyers. And we've been feeling that, I think, on some of our listings, and our team's holding at least a dozen listings active on the market right now, which is the most we've had in years, because we usually just list 5 a weekend and then they sell. So
Yep.
It's a great time, I guess, to boil through to agents. It's a great time to educate people. And we've talked with our team about this, is the news cycle doesn't usually hit for 2-3 weeks, even in today's world that news travels fast. And so if people are on the fence or they're getting pre-approved right now, they might want to think about getting out there in this pocket and this window of time. Because to Luke's point, if rates go down to 5.25%, you're going to see the demand pick up significantly, not just from first-time buyers that maybe were on the sidelines, but also from the move-up buyers. So you're going to see that pressure in different price points in our local area here.
The kicker at 5.25 is I still think if you get to the low fives, you'll see people move out of their first-time home buyer house and move up.
Exactly.
And so you will have more inventory in that kind of market, that first-time home buyer market, which I'm curious to see how that affects demand and prices. Because if we get more inventory, like you're saying, and the demand's not as much as the new inventory, I might actually see it even out.
The challenge is always, though, we've talked about this, the pace at which these changes are happening. Because in some cases, they do create the arbitrage opportunities. Like my one buyer that went under contract 7 days ago, all of a sudden goes, oh, I went under contract thinking I'd have a 7.25 rate. Like I bought this house being like, I'm going to have a high payment. And then now they're like, oh, I saved a bunch of money on my monthly payment because the rates dropped a whole point in a week or whatever it was. Like it does at least allow them to suddenly be like, I got a net positive benefit here. But there's also the component, like if they drop too fast, what happens is we have overcorrections, overreactions, everything. So finding these new normals is always positive along the way. And you want to kind of, ideally we'd ease into them. I do think that the news and what's happened, I mean, and if you followed Japan's stock market since, it ripped back.
It's like up 10%.
It went down 12, then up 10. So it's like it's normalized. Our market pretty much normalized within the day because it dropped like 5, 6, then it ended up, I think, -1 or 2.
It was like the Nasdaq was off 3. S&P was
it's
the
back
biggest
up today.
S&P was biggest drop in 2 years yesterday when on close, but it is back up today another point. Like,
Yeah.
they're coming back, and the yields came back. I think the 2 years back over 3.9 and the 10 years back over 3.8.
I think everyone just wanted to do something. Like they were so sick of doing nothing that they maybe just wanted to rip today. But like it does feel like they're realizing it was an overreaction. And so that should mean that maybe there was a short-term opportunity for the lower rates. But it also, I think, we probably still have a signal here that September rate cuts are, unless the CPI comes back really poor and we have 4%, like if there's a surprise in the negative direction for inflation, it seems that a September rate cut is likely at this point in time. So that's kind of where it is important to kind of keep an eye on this stuff and see where it's going to go, because if we do get that September rate cut, then that will be, once again, positive news for everyone working within the mortgage rate component or piece of things.
Absolutely.
Is that all I had on it?
That's pretty much all I have.
Well, that's all we have this week on the Nerdy Agent Podcast. And as always, remember, be better